Hello and welcome. We're going to work on master budgets today. My name's Jeff from Finally Learn. And here we're going to do just a couple of the budgets. Now, obviously, a company needs a budget to plan. You need a budget to plan your cash in and out and things like that. So let's think about the master budget. The master budget is made up of several components. The sales budget. Now, sales budget is pretty easy because it's usually a percent increase. So we're not going to do that today. We're going to do a couple of ones today. We're going to do the production budget. So the production budget is how much we need to produce based on our sales. And that can be made up of smaller budgets like materials, direct labor, overhead. There's a CapEx budget. Capital expenditures is called CapEx, or the plant assets. Property, plant, and equipment, all that means the same thing. We're going to do the portions of the cash budget, cash receipts budget, and cash payments budget. Then you can certainly plan your operating expense budget, so selling, general, administrative. And then budgeted financial statements, kind of tie everything together. So you take your production and your sales and then your SG&A and kind of work from there. So we're going to spend time on the production budget and then a cash receipts budget and a cash payments budget. All right, so let's look at the first problem, a production budget. Let's say that Razor Company has the following sales forecast for the next 4 months. We've got April, 500 units, May, June, July. And we have some additional information. It says the company's goal is to end each month with ending finished goods inventory, ready to sell, right, equal to 25% of next month's forecasted sales. And the finished goods inventory on March 31st was 190 units. So the ending for March was 190. So the beginning of April is 190. So we need to prepare a production budget for the months April, May, and June. So our next month's sales. So here we're looking at next month, so that is May sales, and we want 25% to be on hand at the end of April, right? So we kind of work backwards. What do we want at the end? We want 580 units times 25%. So at the end of April, we want 145 in ending inventory. Now the sales for this month, we want it to be, we expect it to be 500. So we need how much available? We need 500 plus the ending inventory. So we need 645 available. Now, how much do we already have in beginning? Well, in beginning inventory, we have 190. That's given. So to get to 645, we already have 190. So I'm going to take 645 minus the 190, and we're going to equal 455 is our budgeted production. So we need to produce. Our plan is right now, we need to produce 455 for the month of April. Now let's continue. For the month of May, what is our next month's sales? Well, it's 540 because that's June. And our ending inventory ratio is still going to be 25%. We can go all the way across here. So we can multiply 540 times the 25%, we get 135. Our sales for next month are going to be 580. So we need goods available of 135 plus the 580. So we need 715. Now, what's our beginning inventory? Our beginning inventory is the ending inventory of April, which we just calculated was 145. So 145 is our beginning inventory for May. And so therefore our budgeted production, we need 715. We start with 145. So we need to produce 570 in production for the month of May. Now let's do the final month here. June, next month's sales are 620. We still want 25%. So 620 times the 25%, we're going to have 155 at the end of June. The sales for the month of June is 540. So we want 155 plus 540. We need available of 695. Now, what's our beginning inventory for June? Well, it's the end for May, so that is the 135 that we calculated earlier. So we need to produce 695. We already have 135, so we need to produce, I think I should subtract here, 695 minus the 135, and we have 560 is our budgeted production. So that's how you do a production budget. Now let's do another one just to make sure you understand what's going on. So this format is very helpful for us. So we have a similar problem. Let's say our production budget has April, May, June, and July, 3,000, 4,000, 6,000, and 2,000. And the company's goal, we want ending inventory to be 30% of next month's forecasted sales. So we started at the end of March with 900, so we started April 1 with 900. All right, so what's next month's sales? Next month's sales are 4,000 units, and we want to maintain 30% ending inventory for next month's sales. That means we're going to take the 4,000 times the 30%. We have budgeted ending inventory of 1,200. The sales for the month. Now for the month of April, the sales are going to be 3,000. That's given here in the April forecast. Now the required units available are just going to be, we want 1,200 at the end, plus we want to sell 3,000. So we need 4,200 during the month available to sell. Our beginning inventory was already 900, that's given. And so we need to produce 4,200 minus the 900. We need to produce 3,300. All right, so let's keep going. For May, what is the next month's sales? Well, the next month's sales is 6,000. And 30% is what we want to maintain, so we can just multiply 6,000 times the 30%. The sales for the current month of May is going to be 4,000. So we need available, we need 1,800 plus the 4,000. We need 5,800 available. Now, what was our beginning inventory for May? Well, it's the same as ending inventory for April. April 30th rolls over, and then May 1st, it's the same 1,200. So 5,800 minus the 1,200 means we have budgeted production. We need to produce 4,600 in the month of May. All right, the last month here. Next month's sale for July is 2,000. So we're in June, but we're looking at next month, July's schedule. So 30% of that, we need 2,000 times the 30%. The sales for the month, we think, are going to be 6,000. And so therefore, we need to make sure we have 600 for the ending, 6,000 for this month's sales. We need 6,600. Our beginning inventory is the May's ending inventory, which is 1,800. So we need to produce 6,600 minus what we already have on hand, 1,800. We need to produce 4,800 for the production. All right, so that's the production budget. We've done two examples here. So let's do cash receipts budget. Let's say that J has 70% of its sales on account, and the remaining 30% are cash sales. So anytime, if we have sales of 10,000, we're assuming 70% goes on accounts receivable and 30% is cash. Credit sales are collected fully in the month following the sale. Now, this is important because sometimes we might say half are collected this month and half the next month. Or we could say 60% this month, 30% the following month, 10% the following month. All right, so our forecasted sales for April, May, and June are 525,000, 535,000, and 560,000. The April 1 balance of accounts receivable was 400,000. That also could say the March 31st balance of accounts receivable was 400,000. Same, the ending from March is the beginning of April. So here we're given the beginning balance. So let's calculate a cash receipts budget for April, May, and June. When are we going to collect cash? We may make a sale right now, but we collect the cash next month. All right, so what is our April sales? Our April sales are given at 525,000. Now, we don't collect all that cash this month. We have 70% of that is going to be credit sales. So we're going to take the 525,000 times 70%, and that is 365,500. That means cash, 525 minus what we sold on account. We're expecting to collect cash of 157,500 for sales for April. But don't forget, we have sales in March that we're collecting now. So we're collecting all of the 400,000 sales from March. So we expect to collect 157,500 plus 400,000. So we think we're going to collect 557,500. When we make a sale, 70% of those sales we think we're going to collect next month. So with 100,000 of sales, 70,000 will be collected next month, 30,000 this month. But you have the previous month 70% sales that you collect this month. All right, so let's look at May. May sales are 535,000. Of that, we're going to take 70%, so times 0.7. So that's 374,500 that will be collected in the following month of June. So we're going to subtract out 535 minus the 374,500. So we have cash sales of 160,500, and our collection on accounts receivable is the previous credit sales from the month of April. So I'm going to point to the month of April. We're going to collect the April sales in May. So that's 367,500. We're going to add up the cash sales plus the sales collected from April. So we expect to collect $528,000. All right, the last month is June. So our sales in June are 560,000. Our credit sales on that, 560,000 times 0.7 is going to be $392,000. That means we can expect to collect cash on that this year of $168,000. We're going to collect the credit sales from May in June, and so therefore $168,000 plus $374,500. We're going to collect. Our plan is, our budget is $542,500. So that's how you do a cash receipts budget. Now, they could have different percentages. It could be you collect 30% cash, 30% this month, 20% the following month, and how much I'm missing, and then 20% the third month. So you have some this month, next month, and then the following month after that. So it just depends on how the problem is given, how you figured out how your cash receipts happen. All right, the last one here, let's do a cash payments budget. All right, Zane purchases raw materials on account. And the budgeted purchases for Zane Company is $80,000 for April, $110,000 for May, and $120,000 for June. The payments are made 70% during the month of the purchase and 30% in the month following the purchase. Very similar to the rules up above. On March 31st, the balance of accounts payable was $22,000. So we're going to prepare a cash payments budget for April, May, and June. All right, so what is the April purchases? Well, it's $80,000. So what is the amount that goes on account? Well, it's 30%. So I'm going to take 80,000 times 30%. That's the amount that goes on account. That's the purchases on account. So how much do we pay cash? Well, we're looking at this one. We're talking about how much cash we pay. So the cash we're going to pay on that is $56,000. Plus, we got to pay the 30% from the preceding month. That's $22,000. So we're going to pay $22,000 rather. We're going to pay the $56,000 plus the $22,000. Now, this is a cash payment. This is money going out of our company. It means our cash account is going down, our checking account is going down, because this is a cash payment. This is a overall negative amount for cash. So for the month of May, we're going to purchase $110,000. The amount that's on the account is going to be 30%, so that's $33,000. That means we're going to have cash payments for purchases of $77,000. 110 minus 33 is $77,000. The cash payments on account is going to be the preceding $24,000. So we're going to pay $77,000 cash plus cash on the other purchases on account. So we're going to pay a total of $101,000 for the month of May. All right, June, we're going to purchase $120,000, and on that $120,000, we're going to multiply it times the 30%. That is how much is on account. We'll pay it later. So that means we pay cash. 120 minus 36,000 is 84,000. The cash payments on account is the preceding month's 33, and we're going to pay the 84 plus last month's 33 for a total of 117,000. All right, that's how you do the cash payments budget. We did a cash receipts budget, and we did 2 production budgets. So this is how you kind of get started on doing the master budget, which is a combination of all these budgets together. All right, thanks for watching.